Welcome back to Finance Kida, your go-to channel for mastering finance concepts and acing interviews. Today we'll explore Ind AS 102, share-based payments, a very important topic for interviews. If you're preparing for interviews or just looking to sharpen your understanding of this standard, you're in the right place. Before we start, check out the description for links to our other videos on accounting standards and finance topics. Don't forget to subscribe, share this video with your peers, and watch it a couple of times to solidify your concepts. Let's begin. What is the scope of Ind AS 102? Here, the question assesses on scope of standard, and this standard primarily addresses the accounting for share-based payment transactions, which include transactions in which an entity receives goods or services as consideration for equity instruments. It encompasses various scenarios where share options or shares are granted to employees or other parties. It's crucial to understand that the scope extends to both equity-settled and cash-settled share-based payments, ensuring a comprehensive approach to recognizing and measuring these transactions. Now, let's delve into the next question. What types of share-based payment transactions are covered under this standard? Ind AS 102 outlines three main types: equity-settled share-based payments, where the entity grants shares or options; cash-settled share-based payments, where the entity incurs a liability to pay cash based on the share price; and transactions with parties other than employees, which can involve various arrangements. Understanding these distinctions is vital for accurate financial reporting and compliance. Next question. How is the fair value of equity-settled share-based payments determined? This question is fundamental for understanding Ind AS 102. Fair value determination can be approached through various methods, notably the Black-Scholes model and Monte Carlo simulation. The Black-Scholes model is widely used for its simplicity and effectiveness, particularly for options. It calculates fair value based on variables such as the stock price, exercise price, volatility, risk-free rate, and time to expiration. This model assumes a constant volatility which can simplify calculations but may not always reflect market realities. On the other hand, Monte Carlo simulation offers a more dynamic approach, allowing for the modeling of complex scenarios and variable inputs. It accounts for changing volatility and multiple paths that the stock price might take, providing a more comprehensive view of potential outcomes. Both methods have their merits and can be selected based on the specific circumstances and requirements of the share-based payment arrangement. Next questions. What is the difference between equity-settled and cash-settled share-based payments? Explanation to above question. Equity-settled payments involve providing employees with shares or options to acquire shares, meaning they gain ownership in the company. This aligns their interests with shareholders, fostering a sense of belonging and motivation. On the other hand, cash-settled payments require the company to pay the equivalent cash value of the shares at the time of settlement. This can be beneficial for companies wishing to avoid dilution of ownership, but may not create the same long-term commitment from employees. Now let's discuss vesting conditions. What are vesting conditions, and how do they impact the recognition of share-based payments? Here are some insights about question vesting conditions are specific criteria that must be met for employees to earn their share-based payments. Market conditions like achieving a certain stock price directly influence the likelihood of vesting and are factored into the expense recognition. Non-market conditions, such as an employee's tenure, require no adjustment to the expense but do affect the timing of recognition. Understanding these nuances is crucial for accurate financial reporting. Let's dive into a crucial topic. How is expense recognized over the vesting period in case of equity-settled share-based payments? This is fundamental for understanding Ind AS 102, which will be useful while answering. The expense is recognized based on the fair value of the equity instruments granted. Initially, we determine the fair value at the grant date, which is then amortized over the vesting period. Each reporting period, a portion of that total expense is recognized, reflecting the employee's service during that time. This ensures that the expense aligns with the benefits received, providing a clear picture of the company's financial performance. Now, on to the next question. What happens if the share-based payment plan is modified or cancelled? For the question as well as standard, modifications can significantly impact the accounting treatment. If a plan is modified, We reassess the fair value of the equity instruments at the modification date and recognize the incremental fair value as an expense over the remaining vesting period. In cases of cancellation, the expense must still be recognized based on the original terms, but any unvested awards are typically accelerated, ensuring that the financial implications are fully captured in the statements. Let's dive into a crucial topic. How are share-based payments accounted for in a group scenario, particularly when a parent grants options to subsidiary employees? Insights about this question. The parent company recognizes the share-based payment expense in its consolidated financial statements. The parent records the expense based on the fair value of the options granted, while the subsidiary reflects this in its own books as an increase in equity, specifically under the share-based payment reserve. The key is that the expense is recognized at the group level, ensuring that the total cost of the share-based payment is accurately represented. Let's dive into a crucial topic that often arises in interviews. What are the disclosure requirements under Ind AS 102? Under Ind AS 102, companies must disclose specific information about share-based payments, including the nature and terms of share-based payment arrangements, the number and weighted average exercise prices of share options, and the method used to determine the fair value of the equity instruments granted. This transparency helps stakeholders understand the financial implications of these transactions. Now let's tackle another important question. How would you account for a share-based payment transaction where there is a choice of settlement? Probable answer. In such cases, the recognition and measurement approach hinges on the terms of the arrangement. If the entity has the choice between equity and cash settlement, it must assess the fair value of the equity instruments at the grant date and recognize the expense over the vesting period. This ensures that the financial statements reflect the true cost of the share-based payment accurately. So, if you found this video helpful, don't forget to give it a thumbs up, subscribe to Finance Kita for more insightful content, and hit that notification bell so you never miss an update. Good luck with your interviews, and remember, you've got this. Until next time, keep learning and growing in your finance journey.